Welcome and good morning to this Friday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. Investors in India have one eye on the global trade situation and another on regional tensions as the tit-for-tat between India and Pakistan escalates following the deadly militant attack in Kashmir this week. Stellantis is speeding up its EV entry into the Indian market, and it's doing it with some help from China. And Indian consumer giants Unilever and Nestle India reporting weaker quarterly earnings, hurt by a slowdown in demand and higher costs that dented margins. Right, welcome everybody. The Indian markets join us in about 45 minutes' time. And the setup, I must say, heading into the market open is looking somewhat negative and somewhat fragile. And let me just remind you all that the Indian equity benchmarks yesterday did snap a 7-session winning streak. Risk aversion after the Kashmir attacks that we talked about in the headlines is starting to be priced in and is haunting this market. Indo-Pak relations, remember, were downgraded. Plus, as we also reference in the headline, FMCG story seems to be impacted somewhat and could continue to be by the disappointing earnings numbers from Nestle India and Unilever. In terms of Nifty futures, they are suggesting an opening number in the region of 24,505. So, interestingly enough, it looks as though this could be a picture of resilience at the market open, given where we left off yesterday at 24,246. So perhaps we're looking at some tentative upside in the market when the market opens for the benchmark Nifty 50. Let's give you the dollar rupee rate at 85.2290. Quick look at the Asian markets, and we are seeing once again a very mixed picture, some dispersion. The TAIEX and the Hang Seng Index leading up by 2% and 1.3% respectively. Some relatively middling gains elsewhere. Nikkei 225 is having a good session as we round off the week this Friday, up by 1.4%. However, we are seeing some weak spots, relatively speaking, over here in Singapore with the Straits Times Index. Similar story for the benchmark KLCI across the causeway, Malaysia, Shanghai Composite. Let's call it flat at around 3,300. In the meantime, the US and China can't seem to agree if trade talks are happening at all. President Trump saying, quote, they had a meeting with China without revealing who they were. The White House says lower level talks are underway, but China is saying both countries have not held any sort of consultation or negotiations, adding that Washington should cancel tariffs and unilateral measures on China if it wants to talk. Now, the tariff spillover is leading companies to turn to markets such as India. This is an ongoing narrative. Reports say Air India is in talks with Boeing to buy 10 737 MAX jets that were meant for Chinese customers. Boeing's Chinese buyers sent the planes back amid the trade war with the United States. Air India is now reportedly getting some of those jets for its budget segment, Air India Express. And data analytics firm Databricks is also sensing an opportunity in India. The San Francisco-based company will increase its employees in India by over 50% by the end of this fiscal year. This quick expansion comes as Databricks doubles down on India's growing AI talent pool and investments in the sector. Now, another company that's betting big on India is Ascot. The lodging unit of Singapore's Capital Land is adding 600 units to its India portfolio, and it's aiming to double its portfolio units by 12,000 by the year 2028. Ascot is also tapping into the hospitality market in the country's smaller cities. The latest portfolio addition includes signings in Tier 2 cities like Lucknow, Goa, and Tier 3 city of Thanjavur. There are 97 Tier 2 cities and over 100 Tier 3 cities in India. So that gives you a sense of perspective in terms of the growth potential. I'm delighted to say that Lee Nguok Wai, COO, EMEA, South Asia and China at Ascot, is joining me now. Look, why? Thank you very much indeed for joining us on Inside India. Now, you and I both know that India isn't just one country. It's highly diverse. So geographically, within India, how is Ascot positioning itself?
So maybe hi, Sri. Hi. Morning, everyone. So maybe just a couple of words on Ascot. So Ascot is the lodging arm of CapitaLand, right? We have a portfolio of about 1,000 properties now across 230 cities and 40 countries. About two-thirds of those are under operations. So we have a full collection of brands of around 14 brands covering service residences, hotels, resorts, experience-led social living properties, and branded residences. So actually about India, we view India as a very important inbound and outbound market, considering its potential growth. Currently, our footprint in India is about 6,000 keys, right? Mainly operating in the main metro cities like Pune, Chennai, Bangalore, right? And our growth strategy is actually to have really a dual focus on both geographical and brand expansions. We aim to double our portfolio to around 12,000 units by 2028.
Look, why I've got to say and bring in the issue of perceptions in India now, given the events in Kashmir. And Indo-Pakistan relations are once again deteriorating in the aftermath of this deadly militant attack. Do you feel that this could have perhaps a material impact on the lodging and the hospitality business? Is this a short-term impact, perhaps, that will be felt amongst business travellers and tourists? Or do you feel that this is a market that is relatively resilient?
No, actually, I think that lodging has demonstrated resiliences over the past years, right? And by the way, India, India currently has a very favorable context climate for hospitality growth. When you look at it, there is a pretty robust GDP growth. We see rising disposable income. We see actually, I was in India two weeks ago, and I was actually amazed by the expanding infrastructure and the fast urbanization. And one more point I want to add, and I saw some interesting numbers. There is still limited supply. A very interesting figure I want to share is that, for instance, if I compare, India today is around probably 7,000 hotels, roughly 450,000 keys, right? If I compare it to a country like the US has around probably 10 times more than 5 million keys for 350 million population, while India is 400,000 keys for 1.4 billion population. So
yes,
probably 10 times more. US has 10 times more keys and 4 times less population. So, all this is very, very encouraging and promising for India. This makes the whole travel more accessible, connecting to new domestic destinations and expanding the hospitality footprint within the country. There is actually very, very exciting and huge headrooms for Ascot.
Yes.
For Ascot Flex Hybrid model and also multi-typology brands to grow in India and to meet the evolving needs of each guest. Maybe one point, if I may, Sri, one point, if I may add, is that, we're talking about all the guest needs, obviously, but there is a balance we need to actually focus on. Obviously, for guests, our brands, our multi-typology brands can offer a wide range of accommodations, flexibility to cater with different travel purposes. Our loyalty program, which is actually pretty young loyalty program, right? Close to 6 million members now, but 90% of our direct web or app bookings are coming through this program, and we see that the loyalty is an evidence, obviously. Yes. a value add, because our members are spending 55% more than non-members. But we also need to focus on the investors and owners' interest. Our products, we are able to deliver strong value propositions with efficient product design to maximize revenue opportunity, faster market adoption, and we have the flex hybrid model to pivot actually from either short stay or long stay to demonstrate resiliences even during crisis or market cycles.
Yes, and especially amongst the younger demographic, Gen Z and millennial, and the Life brand speaks to that. Having said all that, Ngoc Wai, having said all that, in the here and now, is your India team telling you that they are getting cancellations in the wake of this attack?
So far, our pickup, our numbers are quite stable. Obviously, we see some cancellations, but not major. The situation is still very promising and encouraging. There is no huge turn down foreseen so far. Yeah.
Understood. Let's talk about business conditions, Ngoc Wai, because the hospitality and the high-end service apartment sector in India, it's dominated, isn't it, by the domestic players, and they have very strong offerings. So what is Ascot's unique selling proposition in India? Elaborate on that if you can, and how you're managing this intense competition, and what is giving you the edge in this vast market?
Yeah, thanks for the question. So that's what I was saying, that actually the Indian market is actually the supply is pretty limited, right? And when we see with the country population surpassing 1.4 billion in India, and with a median age of just 27 years old, there is a strong rise of Indian urban millennial and Gen Z workforce, right? Growing digital nomads trend. We see some of our brands actually very, very suitable for the new evolving needs of hospitality demand in India. Like you mentioned just previously about our our experience-led social living brand, LYF, Live Your Freedom, right? Which aligns perfectly with the new gen travelers' evolving needs. What are they looking for? They're looking for tech-enabled experiences. They're looking for actually very efficient room sizes. They are not actually looking at staying in a room, right? They are actually looking at enhanced public areas, common spaces to ease socializing, interacting, sharing, and especially strong bonding with local community or neighborhood. So these are the brands we're seeing able actually to be very suitable for the new Indian Gen Z market.
And I'm sure wellness and experiential part of that business ties into that, but it's very exciting. And my question is, are you finding the right talent? And can you offer any insight into the hiring program, training the next generation of managers and skillful concierges? Because at the higher end, I would imagine especially, customers still want a personal human touch point in the hospitality and lodging business, yes?
Yes, definitely. Hiring or talents are actually the key centrics, I think, to deliver the guest experiences. And not only in India, by the way, this is across the world. So we have defined a very, very sophisticated and new tools to train our staff, and to make sure that this is this is delivered on the ground. One thing is also that we are using now AI and the new IoT technologies to actually enhance our guest experiences on the ground, also our operational efficiency, to make sure that our team on the ground are here to serve the guest rather than doing administration stuff.
Very ambitious plans to expand the portfolio in India to 12,000 units by 2028. So does that imply a joint venture? Does that imply a deeper partnership with existing domestic players? Is that what is needed to win a bigger share off the market, or is Ascot going it alone?
I mean, we have our own plan to grow alone, but we are always open to look and work with the best local players, local partners to grow together. By the way, we have demonstrated this also in China, where we recently formed a joint venture with Jinjiang, right, which is one of the largest hotel group in the world, and to grow one of our extended brand called Quest in China. So whenever there are opportunities to collaborate and to grow in the countries, we'll do. But I mean, on the meantime, we are also staffing ourselves, preparing ourselves to hit this 12,000 ambitious target that you mentioned.
And just very finally, Nok Wai, as a reflection of business and consumer confidence, and you operate in leisure and in the lifestyle with Life and that brand, so you're a very important barometer of those two market segments. As a reflection of business and consumer confidence within India, what are business conditions and the outlook telling you in the next for the next 6 to 12 months?
I mean, when we look at the current economical context, I mean, it's actually pretty difficult to predict, right? I mean, the crystal ball is difficult. Every day we have a very strange and surprising news. But I mean, the hospitality segment and the hospitality business is still doing well. The prediction from most of the experts of this segment is still on the rise. So, I mean, I'm actually very excited and still very optimistic for the coming month.
Great to hear that, Nok Wai. Thank you very much indeed for those insights on how Ascot is looking to tap into the vast potential in the lodging and the hospitality market segments in India. Thank you. Lee Nok Wai there from Ascot. Thank you, sir. Coming up on the programme, EV momentum is building with Stellantis and VinFast racing into the Indian market. We will tell you more after the break and also head to the auto show in Shanghai. Welcome back. Global automaker Stellantis is speeding up its EV plans for the Indian market. It intends to start selling its EVs developed by its joint venture partner, Chinese joint venture partner, Leapfrog Motor, in India by the end of this year. The head of Stellantis's China operations making those comments at the Shanghai Auto Show. However, he did not say which models would be sold or if they would be manufactured in China or domestically. On that note, another EV maker is also speeding up its plans in India. Vietnam's VinFast is looking to open its factory in the state of Tamil Nadu soon. JP Yong has more details and joins me now. JP Yong, why Tamil Nadu? What's the secret sauce?
Well, you know, at the risk of India-splaining to you, since you are the anchor of Inside India, you know, it's not just the EV makers or the car makers going to Tamil Nadu. Remember that a lot of factories have been set up there, and in some ways, looking at Tamil Nadu for India now, it reminds me of Guangdong for China, say 30 to 40 years. And maybe this is the strategy of India as well. Try to bring a lot of the manufacturing to really take root in Tamil Nadu, including the likes of VinFast. The interesting thing about this factory they're setting up in India, and by the way, they're also setting up one in Indonesia, will be operational by October. They are expecting this factory to be operational in Tamil Nadu by June. But they only broke ground on this as recently as February of this year. So that's a 4-month lead time to set up a factory in Tamil Nadu. Now, we have to remember that EV factories are a little bit easier to set up actually than the conventional because they have fewer parts tree, which means that the assembly lines will be less complicated. But also these are complete knockdown facilities, meaning they will be importing all the parts, mostly from Vietnam, bring them to Tamil Nadu, and then the Indian workers on the factory line will then just plug and play and do the final assembly of the cars there, which means it will be easier process actually, and means that they can set up and start faster. But 4 months is a very, very quick time to set up a factory regardless of the simplicity or relative simplicity of that particular facility. Now, we also have to remember that VinFast, they're not just facing rising competition in India, but really globally. So for them to really start this expansion is going to be very important, and they'll have to move very quickly. This is also costing them a lot because, as we know, based on their quarterly results, Sri, they saw a net loss of about $1.26 billion. That's up 81% on a year-on-year basis. Full-year losses at $3.2 billion. But take a look actually at the balance sheet for VinFast, and this might be a bit more worrisome. There is an equity deficit, meaning their liabilities exceed that of their assets, and it's now ballooned to about $3.9 billion US. So they'll have to address the balance sheet insolvency. They'll have to look at their leverage, and they'll also have to be able to balance that while they try to maintain this very fast expansion that includes India in their strategy.
Yes, it's fascinating. There's a case to be had for access to a skilled, talented workforce as well, including many women, which the southern states have really been driving. Thank you very much indeed for that, JP. Right, let's head out to the Shanghai Auto Show now. Lynn is on the ground and has an exclusive update for us. Lynn, hi there.
Yeah, good morning to you, Sri. I got a chance to sit down with the CEO of Pony AI, a robo-taxi company, and James Pong revealed that the company is signing an MOU with the Chinese tech giant Tencent, and basically, you know, what this means is that potentially we could be looking at the robo-taxi services that Pony AI provides being embedded in the ubiquitous WeChat app. Let's listen.
We actually have discussed with Tencent for quite some time because Tencent has a huge user base. It has some cloud offering as well. So I think it's also from culturally, it's a good fit for both companies. So we had quite a bit of discussion. The current collaboration will have two folds. One is on user acquisition. So the WeChat has all sorts of applications in there, and one of the applications is for mobility. So we'll at some point, hopefully in the very near future, in the WeChat, you'll be able to, as a channel to get a robotaxi ride.
And if this does progress, how significant is this potential partnership?
Well, as we are scaling up, providing a good service to the user is one of the essential key for our success. And Tencent definitely has, one of the applications with the biggest users. So I think that really is a win-win collaboration.
And this announcement also goes hand in hand with the unveiling of Pony AI's next generation robo-taxis, which you can see behind me here as well. Now, as part of this, they're looking to also scale up their fleet. And, you know, the reason is, one of the reasons anyway, is the fact that they've been able to find efficiencies and really lower their costs. Big part of that is their components, including LiDAR sensors as well. And we got a chance to speak with one of the major LiDAR providers here in China, RoboSensor's CEO Mark Chu, who says that he sees the growth story to be exponential. Let's watch.
The wave of autonomous driving is spreading from China to the world. So we anticipate in the next 1 or 2 years, the mainstream OEMs in overseas will use LiDAR to equip in their vehicle to enhance their autonomous driving capability on a large scale. So for preparing this trend, actually right now we have already obtained 8 design wins from different OEMs in overseas, covering like Europe and the United States and Asia. Yeah, of course.
So 8 contracts, as you say?
Yeah. 8 design wins.
With OEMs?
Yeah, with OEMs. So yeah, one thing I need to mention is we are the first one to bring the LiDAR to automotive grade mass production. So our first client is a North American EV maker. And another thing I think is worth to talk is in Japan, the top 3 best-selling OEMs, we have signed a contract to provide them the LiDAR in the next 2 to 3 years.
And Mark has spoken about the fact that they see this growth, as you've just heard there, in terms of the electric vehicle space, that increasingly more electric vehicles are adopting LiDAR systems as, you know, I guess an extra layer in terms of the safety side of things, but also in the robotic space, particularly as, you know, we've been seeing, I guess, the potential there in terms of AI as well, Sri.
Fascinating, Lynn. Car makers evolving to tech companies. And a car now is a smart device, a great big smart device on wheels. Lynn, thank you very much indeed for that. We're back in 2 minutes. Welcome back. You're watching Inside India. Here are some of the stories that we are keeping tabs on outside of India. Tensions between India and Pakistan are simmering after a horrific terrorist attack on tourists in India's Kashmir. India has accused Pakistan of supporting cross-border terrorism in the wake of that attack that killed 26 people. New Delhi has suspended a key water-sharing treaty with Islamabad, closed the land border crossing and cancelled visas for Pakistani nationals there to leave India by Sunday. Pakistan is refuting India's allegations and deemed these measures, particularly India's suspension of the water treaty, as an act of war. Pakistan has closed its airspace for Indian airlines, suspended trade with the country and paused a $3.3 billion canal irrigation project. And in the meantime, Bangladesh has signed an $850 million deal with the World Bank to boost jobs and trade. The bulk of this funding will be used to expand and modernise port facilities in southeastern Bangladesh. Right, we are counting down to the market open in India. Let's give you a glimpse of the futures picture. We're about just under 15 minutes away from the open. GIFT Nifty futures are implying an opening number in the region of 24,485. So we are actually looking at a modest incline of about 200 points or so for the broader market, considering where we left off yesterday. And yesterday's session was one in where the Indian benchmarks did snap a 7-session winning streak. Risk aversion, as we noted in the headlines after the Kashmir attacks, the downgrading of Indo-Pak relations, plus the FMCG story did seem to be impacted by disappointing earnings from Unilever and Nestlé. India, however, it does appear that we may be in for a modest bounce back in the session that kicks off in just under 15 minutes. In the meantime, the National Stock Exchange of India has tightened its rules for small and medium enterprises. We were talking about this yesterday. Stocks of these companies looking to shift to the NSE's main board will need at least $1 billion in annual revenue to qualify. Indian markets regulator has already toughened its listing norms for smaller companies. And in the meantime, India's growth prospects have received multiple forecast cuts recently. A Reuters poll is now expecting GDP to grow at 6.3% in FY 2025-26. That expectation was at 6.5% in March. And the International Monetary Fund, the World Bank and ratings agency Moody's have all lowered their GDP expectations for the current fiscal year. India is now projected to grow within a range of 6.1 to 6.3% after these downgrades. However, all of them still find the country will be relatively stable, compared to its regional peers. Let's do a deeper dive on the macro and the markets for India with Subhadeep Rakshit joins us now, Chief Economist at Kotak Institutional Equities. Subhadeep, thank you very much indeed for your time today, sir. Where are you putting headline growth for India in the current fiscal year? Where, in a week where the World Bank and the IMF have cut it to 6.1, 6.3%, are you within that ballpark?
Well, I'm a bit lower. I would say when the tariff cuts had tariff increases had happened, April 2nd, sometime after that, we lowered our forecast to a range of 5.8 to 6.2%, with a central point estimate of around 6%. Now, the point is, if you look at the tariffs and how they have been playing out, there's a fair amount of flip-flop that is happening. So there is no policy certainty in terms of what the end tariff rates would be. And at the same time, this induces a fair amount of uncertainty on the investment cycle. Now, we don't know what the global growth will be, but with the fair assumptions that the IMF is making, I think we will be somewhere around a 6 to 6.2% in terms of India's GDP.
Subhadeep, let me just challenge that view. And why so pessimistic when, in a week where we have seen Vice President Vance visit and arguably facilitate and advance the momentum towards a BTA, it feels like India is in the front of a line with the US for a trade agreement. And if that does materialize during the 90-day tariff pause period, or in the autumn at the latest, then surely that's going to be a shot in the arm, isn't it, for the Indian economy?
Absolutely. Let me just break it up in two parts. One
Please.
is when we talk about the growth impact, it's important to note that in the near term, the impact on the economy is not much about the impact of the tariff as much as it is due to the impact of the uncertainty on tariff. The constant flip-flop and the lack of any clear policy path risks impacting investment growth. Now, we have seen a fair amount of easing from the RBI through the lowering of rates, surplus liquidity, easing of the regulations. But the investment cycle depends more on the visibility of demand and easing of regulations rather than, and a fair amount of policy stability, I should add, rather than only on the cost of capital. Also, with the slower global growth, and this is not just about India. I mean, US could be slowing down. And we'll get to know in a month or two how much that slowdown is. But what it risks is, from the India standpoint, that the services exports could be impacted, and the remittances which we receive from the non-resident Indians could also be impacted. And all of those
that's a very important point,
the
yes.
growth prospects.
That being said, Subhadeep, if we do see a BTA materialise before the year is out, then can we upgrade our expectations towards the Indian economy and be more confident of growth in the region of 6.5%?
Well, surely. I mean, look, I would rather push it a bit more towards later half of FY26 and into FY27. But I think, I think I should qualify it by saying that, India is well aligned with the US from a geopolitical perspective. We have a pretty large dependence on imports of goods such as energy, defense, machinery, which all go well for a beneficial bilateral deal. It's also an opportunity for us to get inserted into the new supply chains or any kind of build out that might be happening, or in terms of the shifts away from shift in the productions away from China. And hence, I think it is a positive that we should be considering, but not in the near term. It doesn't play out in the near term as such, but definitely a positive that plays out in the medium term. But also, to capture this, you require a shift towards a more open economy with lower tariffs, a bit of a higher competition for the Indian corporates, and also policymakers at various levels to kind of deregulate, lower the overall cost of running a business. And that's how you gain the competitive advantage.
Subhadeep, despite the absence of a US-India trade deal, it's been a pretty good week or two, hasn't it, in terms of either firm or intended and potential FDI commitments? We've heard from Tesla, we've heard from VinFast, we've heard from Flipkart returning to India. How would you characterise where that puts the FDI prospect over the next 6 to 12 months for India?
Well, that's definitely on the positive side because, as we see the world kind of now getting a bit of more rearrangement in terms of the trade flows, etc., I think the FDI flows will also get oriented a bit more towards India. India, historically has seen a good amount of flows. On a net basis, there has been a fair amount of weakness that has set in over the last couple of years. But with the markets where they are, probably the outflows would be now moderating. And hence, from an inflows perspective, the numbers would look much better. Certainly, the kind of trade deals that are due to happen, the kind of positivity that can come from a rearrangement of the trade flows will go a long way in kind of pushing towards that, higher FDI, more quality FDI coming into the Indian economy and probably sustain growth for a longer period of time than what we are currently experiencing.
What sort of state is the Indian consumer in? We got some pretty bleak readings in terms of the earnings from Nestle India and Unilever. We also have this narrative of a rising middle-class debt crisis brewing in India. However, FMCG still seems to be a favoured sector from a portfolio investor standpoint. How would you assess the resilience or otherwise, Subhadeep, of the Indian consumer and that narrative?
So I think one point to remember here is that the volume growth of most of the FMCG companies, of the listed companies, have not been great, right, over the past few years. And there has been a constant shift from either volumes being driven by the rural segment and or the urban segment. And currently, we are in a phase where the urban segment is not doing as well. The rural is doing relatively better than the urban segment. A lot of it is to do with what has been panning out in terms of the growth drivers over the past 1.5 years. But I think there is some sort of cyclical turnaround that we are seeing in some of those drivers, whether it is in terms of formal employment, whether it is in terms of the government spending, whether it is in terms of the troughing out of the personal credit cycle. I think these are a fair amount of positives that we should be building in. The government in the budget has also talked about income tax relief. And I think these over the near to medium term should play well for the consumption in terms of slightly pushing that consumption story for the urban consumer slightly ahead. Having said that, I think it's a more structural problem in terms of job creation and quality employment, which kind of weighs down on a sustainable, long period consumption growth at a mass level.
Yes, exactly. And Piyush Goyal was talking about this and exhorting the startup ecosystem and the IT ecosystem broadly to create the right conditions and move up the value chain to create quality jobs and move beyond just delivery boys and delivery girls. Is that happening at a top-down level, Subhadeep, this move into advanced manufacturing? How confident are you that we are seeing momentum, or is there inertia?
Well, if you look at the past few years' data, especially post-COVID, I don't think there has been a shift, and this is from the surveys that are available, that there has not been a significant shift towards manufacturing or towards services. Whatever shift we are seeing is still in a bit of a low-quality, low-paying kind of jobs. But I think some of the changes that we were talking about earlier in terms of FDI coming in, in terms of the PLI, in terms of the manufacturing sector being pushed from a policy perspective, I think that should help over the medium to long term. But if you take the history over the past, let's say, 4 or 5 years, there has not been that kind of a push towards manufacturing yet.
So does that imply that Make in India and production-linked incentives, that needs to be overhauled, it needs to be refined and reformed, and that there needs to be a new way forward with this policy?
See, we have to remember that the PLI scheme is across multiple sectors which are diverse in nature, and none of these sectors you can't link all of them with one policy. And to that extent, and if you look at how the policy making has happened, the government has done a very good job in terms of fine-tuning each of the PLI schemes and tailor make it for that particular sector. But where the problem lies is not just in terms of the policy itself, but also globally. If you look at some of the sectors, for example, battery or solar modules, etc., even steel to some extent, there is a huge overcapacity that the whole world is dealing with from China. And if that overcapacity continues to be an overhang, and specifically from India's perspective, the policy could be well made, but there could be a period where the policies can't take off simply because the global environment may not be successful. To that extent, I think manufacturing doesn't get built out in a 2 to 3 year period. And here we are talking about overhauling or kind of reinforcing various new sectors also. And I think to that extent, we need to give the PLI a fair amount of time. We already have seen success with the mobile phone manufacturing, some part of the electronics component, where we have had large global players come in. And I think some of the domestic companies as well as some of the global companies can benefit from the PLIs, but we need to give that time because the global environment may not be conducive always.
Subhadeep, what's your take on the inflation outlook? Oil prices appear to be in check. we've had favourable monsoon rains. So agricultural commodity, food inflation seems to be in check. Do you think the picture will remain relatively benign for India and inflation?
Yes, my forecasts are for an average of 4% CPI inflation, average of 4% for FY26. And one of the assumptions in that is that food prices shock are absent in FY26. That's a big assumption. Nevertheless, if you look at the underlying inflation over the past 1 year also, you'll see that barring, let's say, vegetable prices, if you kind of exclude the vegetable prices, you will still have a very decent inflation print, which is probably sub 4%. And that, I think, is one of the strong areas in terms of our comfort in terms of inflation remaining benign. Of course, we'll see core inflation starting to inch up. It's already inching up. But at the same time, barring any food price shocks, I don't think there should be much of an issue in terms of the inflation. In fact, if you look at how the trade lines and global trade lines are panning out, there could be a fair amount of fear in terms of kind of disinflation coming out of China in terms of its excess capacity, etc. And I think that's fundamentally one of the reasons why we are comfortable on the inflation numbers. That the core inflation should be well anchored. And I think the only joker in the pack in that sense is the food prices, specifically the short cycle crops like a fruit or a vegetable, which I think you have to deal it as it comes.
Of course. So, where then does this put the RBI, and what is the appropriate path of monetary policy in the outlook?
So the RBI has already embarked on a path of looser monetary policy. So rate cuts of 50 bips are done. Another 50 bips is already part of the consensus forecast. Liquidity is absolutely, it remains in surplus and will continue to remain in surplus. Regulations are being eased on the bank credit side, bank and NBFC channels. For me, the way I see it, given our GDP forecast of, let's say, around 6 to 6.2%, plus inflation staying around the 4% mark for most of FY26, we are looking at a further 75 to 100 basis point of rate cut against the consensus estimates of around 50 bips. Much of it centers around the growth uncertainty, growth slowdown, and the comfort on the inflation. On the FX side of things, I think the RBI is comfortably placed in terms of the depreciation or the appreciation bias. It's a two-way movement that is now that we see in the INR, and hence there is no any kind of burden from the external sector on the domestic monetary policy.
On the fiscal side of town, Sivadeep, how do you see the outlook developing there? Because it's been a constant focus on fiscal consolidation, fiscal discipline, but I've got to say, if the global economy does turn south, then India's going to have to reconsider that and move pretty quickly with perhaps economy-wide stimulus. So there is no clear path, is there, in terms of the fiscal outlook?
No, I think the fiscal consolidation path remains. And I'm going to qualify it by saying that if there is a global growth slowdown and we get impacted as, and with a lower growth, and if there needs to be a fiscal stimulus, the hit usually comes on the taxes front that the government will have to kind of bear. So the taxes kind of go lower, but we kind of underestimate probably the kind of RBI surplus that can be transferred to the government. Again, this year. Last year, we had a 2.1 trillion rupees that was transferred. Budgeted estimates, I assume, would be a similar number for FY26, but we can easily have a trillion to 1.5 trillion kind of a beat in terms of the RBI transferring higher surplus to the government, which can cushion any kind of tax shortfall, if any, and any kind of stimulus, whatever the government might be planning. I'm not getting into that in this discussion, but any kind of stimulus measure required, I think the government will have resources without compromising on the consolidation path.
Sivadeep, it's interesting. The past couple of weeks since we launched this new program, the India story amid the tariff uncertainty has emerged as one of resilience. There's the tariff differential, the tariff arbitrage. There's sell China, buy India. There have even been some voices who have said, look, India is emerging as a safe haven within the EM landscape and may even benefit from a credit ratings upgrade. Do you believe that would happen?
Credit rating, I'm not sure. I mean, the credit rating agencies have a host of metrics that they kind of monitor. But I think it's important to note that the government, for its part on the fiscal, is now conforming and kind of has promised on a debt to GDP path which kind of by 2030 reaches around 50% odd, right? Now that is a commitment that the government has made. The government has walked the talk in terms of sticking to the fiscal consolidation path. The monetary policy has been spot on for most of the period over the last 4 or 5 years. And I think the fundamentals, kind of would indicate that there is a fair chance that one should see favorable action from the rating agencies. But again, the rating agencies, I think, have multiple metrics that they would consider. So I would not hazard a guess what they would be doing. But for my part, I think a fair amount of move has happened. And I think most of the other moves in terms of whether monetary policy, fiscal policy, GDP per capita, etc., will continue.
And to your point, given the flip-flopping in the tariff narrative, caution may be the better part of valour from the rating agency's point of view. Sivadeep, thank you very much indeed for joining me. It's been a great conversation. Sivadeep Rakshit there from Kotak Institutional Equities. Right, Indian markets are now online and are on the incline by a modest 0.2%. We will take a look at the movers in the market in 2 minutes. Welcome back, everybody. The Indian markets are a few minutes into the trading session, and after the stumble yesterday where the benchmarks snapped the 7-day losing streak because of the risk aversion associated with the Pahalgam attacks, we are starting to see a very modest rebound on the Nifty 50, which is up by 0.3%, 24,310, as you can see here. Let's give you the dollar rupee rate as well. We are seeing some strength in the Indian rupee as well. 85.0990 is where we stand. Let's do a deeper dive and take a look at some of these sectors. Remember, we are in the thick of the earnings season. Axis Bank shares are in focus. Rough session, down by almost 3%. This is after the Indian private lender beat quarterly profit estimates and flagged confidence about retail loan growth improving in the upcoming quarters, even as it flagged that corporate loan growth would be muted due to tariff uncertainties. However, the market's not really running with the positive elements of that narrative. We're also watching shares of Hindustan, Unilever and Nestlé India. Disappointing earnings released yesterday. FMCG, consumer stocks were down yesterday. As far as today's session is concerned, we're seeing an extension of those losses for Nestlé, down by 1.2%. Some stabilisation in Hindustan Unilever. Consumer goods giants, remember, posting lower than expected quarterly profits due to rising input costs and muted urban demand that have dented profit margins. Hindustan Unilever cutting its near-term margin forecast to a range of 22% to 23%. Nestlé India has been investing about 65 billion rupees to develop new capacity to boost manufacturing. Right, let's take a look at the tech space. Tech Mahindra's reporting a strong finish to FY25, profit surging nearly 80% in the fourth quarter, even as revenues missed due to uncertainty about client spending. The IT services company seeing early traction in advanced technologies like AI and 5G, even as client spending remains cautious, which has been a theme across the sector, across some sectors. Meanwhile, Persistent Systems also clocked solid growth with profit up by 25% and revenue rising by a similar margin. The company says it is now eyeing a $2 billion revenue target by FY27, driven by platform-led innovation. This comes even as the broader macro environment remains uncertain for the tech industry. Right, that is it for today's show. Next week we have a big lineup. Have a good weekend when it rolls by. We'll see you next week.